There are many ways to pay your income tax to the least by investing into the different tax shelter saving accounts. But there are some other creative ways too, and I'm gonna talk about the same in this video. My name is Mayur, I live in Canada and I work as an engineer, but I love to talk about money and mindset. In this video, I'm gonna talk about capital and the carry forward losses. These two techniques you can use to reduce your taxable income so that you pay absolutely least amount of tax to the government and you have more wealth at the end of the year. So stay tuned. I'm sure you all would have heard about capital gain from the different sources. But let me try to explain this in a very simple example. Let's assume that today on 31st of January 2026, you are buying stock of Apple worth of $1,000. Now let's say this stock's value is increased by $2,000, and if you sell it on or before 31st of January 2027, if you sell it before a year, whatever gain you have will consider as a short-term gain. And let's say if you sell the same stock after a year, that means if you sell this Apple stock on 1st of February 2027, whatever your gain will be considered as a long-term gain. In this case, let's assume that $1,000 worth of stock is now $2,000. That means your gain is $1,000. But although the gain, whether it's a short-term or the long-term gain, it's only $1,000, the amount of the income tax that you will be paying on this $1,000 will be different in different countries. Now, since I'm in Canada, I will be considering taxation systems that we use in Canada. But you can search the tax implication of the capital gain in your country, but the basic fundamental will be the same. So in Canada, we do not pay the total tax on the total net capital gain. Here we use a term called inclusion rate. When we say the inclusion rate, that means we will not be paying income tax on the total capital gain of $1,000 in our example. In Canada, the short term of the capital gain taxation is only 50% of the capital gain. So in our case, the government will not charge the income tax on the total, that is $1,000. But the 50% of that, that means $500, will only be charged for the income tax. Now, how much income tax will be there on that $500? That will be depend on your total income. Let's say at the end of the year, you are earning $100,000 from your day-to-day job or from your business. Plus this $500 will be added to your total income. That means you will be paying now total income tax on $100,000 and $500. Now let's say if you have bought these stocks in some tax shelter saving account, like in Canada, we call it as a tax-free saving account, you will be paying absolutely zero tax on that, because whether your capital gain is $1,000 or $100,000, the benefit of this account is that you pay absolutely zero tax in your capital gain. But now assume that you have bought these stocks under your RRSP account, the Registered Retirement Saving Plan. Then the total amount of the tax you will be paying on your capital gain will depend on when are you withdrawing that money to your regular account. In fact, I have made a very detailed video how RRSP work in Canada. The link in the description box, or also you can click over here and you will see some of the hidden secrets that you can take benefit from RRSP. But now suppose let's assume that you have bought your Apple stocks in your regular account, the non-registered account which has absolutely no tax benefits. Then you should make sure that whatever your capital gain is, that will be added to your total income for that particular year. If you are a high earner and you belong to the higher tax bracket, your capital gain will be taxed at the same tax bracket that you are paying tax to your regular income. That means you will be end up paying comparatively more income tax for that small capital gain. That means it is not just important that which investment asset you buy, whether which stock or which ETF, but it is crucially important that which investment account you use to do this transaction. And at the same time, it also plays a crucial role when are you selling these products in your different accounts. These all different parameters will play a very crucial role deciding how much income tax you will be paying to the government. Carry forward losses. Have you really heard this terminology before? If you have heard, please do me a favor. Pause this video and explain the carry forward losses into the comment box. And before that, let's understand why some people are afraid to book the losses. The simple reason is that they think that booking a loss is not a good idea at all. but in fact that it is totally wrong. Sometimes you have to sell the investment asset that have been remain very steady or declining in the last 2 to 3 years. There is no benefit of keeping them in your account because they are ultimately gonna go down and you will be in the loss. It is better to sell that investment feature as soon as possible, and whatever money you get in return, you should try to buy a good investment asset that can explode in the next 2 to 3 years. People think that they are not at the loss until and unless they sell that product. But they don't understand is that the real loss is holding the bad investment asset in your portfolio. Let's say unfortunately you had to sell the stock which is performing low and you had to book a loss. But don't worry, I have one very solid way that you can use to convert this loss into a benefit and that you can take while you file your taxes. And for that, let's understand what is carry forward losses. Carry forward loss is totally opposite to the capital gain. We will use the same example of the Apple stock that we used to understand the capital gain. Now, in the capital gain, our stock price was increased almost double. Let's assume that your $1,000 investment remained $500 after a year and you have decided to sell because you do not want to make further losses. Now, when you sell these stocks at the 500 losses and when you sell them, that 500 loss will be a tax shield. Now, the interesting thing is that you can use your capital loss against your capital gain and that will reduce your total taxable income. Now assume that you have two stocks you are selling in this year. One stock you are selling at the net profit of $600 and this Apple stock you are selling at $500 losses. If you combine this, you have overall gain of $100. If there is no concept of the carry forward loss, you will be paying more income tax on your $600. Now, since we have the concept of carry forward loss, we can use the capital loss against the capital gain. Now, in this case, we will be just paying income tax on the net $100 profit. In Canada, you can use this carry forward losses indefinitely in the future. That means, let's say if you have been doing losses in many years, you can use this against the gains that you will be doing in the next years. Now, if you are doing a daily trading in your non-registered account and if you are ignoring this feature, you are making a very big mistakes. Ever since I have found this out, in case if I make a loss, I will be keeping a track of that and will be reporting to the government when I file my tax. It is very obvious that if you are doing a job and if your salary is comparatively higher than the average normal people, you will be falling into the higher tax bracket. In Canada, our tax system is very progressive. That means you will be paying more income taxes than others if you are earning more than others. It's very simple. Sometimes even you might feel that you are doing job for the government, not for yourself. But there is a big difference between earning more and keeping more. Most of the time, we pay around 20 to 30% of the income tax on whatever we earn. And that is why I make my financial decisions not on the gross salary, but on the net salary. How much dollar I'm gonna keep in my bank account is really what matters, not what is written on the piece of paper on my offer letter. So if you are a high earner or your salary got increased, the first step I would do is to decide how can I own money. Because if your salary is increased or if you are earning more, your overall tax bracket will be a little bit higher. And if you do not tax planning, then it will be like you are working some extra hours for the government for absolutely free. If you are a tax-aware investor, you must know that how much amount of the tax you will be paying and how much amount of the tax refund you will be getting at the end of the year. If I talk about myself, I generally get the tax refund in the range of $15,000 to $16,000 every year. And my role in financial planning is to find ways so that I can pay least amount of the tax. So let's start from we had started. When I realized that I'll be paying $20,000 as an income tax in 2023, I thought it is insane. $20,000 from my pocket going to the government is not a good deal at all. I thought that something needs to be done. Somehow in 2024, I will have to find out some ways so that I can pay least amounts of the tax to the government. And at that time, I started researching about different tax saving accounts in Canada like RRSP, TFSA, First House Saving Account. My belief is very clear. I want to save as much of as tax possible. And for that, if I need to do investment in some tax saving accounts, I will do that. So my system for this is very clear. At the beginning of the year, I just know that how much limit I have in these saving accounts. And based on that, I just invest partial amount every month so that at the end of the year, I do not have the last minute rush. Generally, at the end of the year, when I find out that how much will be my total taxable income, I just figure out the tax impact at the same time. In between, you do not need to do anything. You just make sure that you are investing based on your limit available, because if you go beyond the limit, there will be some penalties to pay. So now I want to know from you whether you are a smart earner or the high earner. Just comment in the comment box. So if I'm earning well, the only one mindset shift I would be that I want to invest more. And at the same time, I can do that if I'm saving more on taxes. It's very simple. If I had known this stuff before I started earning, I would have kept only one thing in my mind: earn more, invest more, get more tax refunds, and repeat the stuff. The cost of ignoring the tax benefits will be thousands of dollars in some years. And once it is gone from your pocket, it is absolutely very hard to get it back from the government. So if you really have made up to this point, I really appreciate your patience and thanks for watching this video. The only one step that I want you to do is that comment into the comment box that how much income tax that you have paid last year and how much refund that you would like to get this year. I really hope that this video has motivated you to do the tax saving and the planning. Until I see you in the next topic, take care and bye.